The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And boy, we're going to get you ready to go. We don't have that much time before the end of the year, and I'm going to tell you the changes you need to make before 12/31 of 2019 will save you money. And we just came back, by the way, we went to this Internal Revenue Service. It really wasn't put on by them, but it was, we were talking about taxes, seminar in Atlantic City this week. And so we're chocked full of great ideas, and you know, it's really good to go to those kind of things because it kind of gets you re-energized for what's happening and make that final push to make sure you save people money. And that's what we're all about. I'm Esther Gulius, the Tax Lady from EG Tax. I'm joined in studio with Christopher Fabian. Hey, Mr. Fabian, how you doing?
Hello, Esther.
Hello, Christopher. And Tiffany Fabian.
Hey there, Esther. Happy Saturday. Yeah, we learned some cool things about the law, some things
Well, I think the thing is, the law was passed the year before,
right?
But they really weren't sure because it was so complicated.
Yeah.
Exactly how, actually, I think they're still not sure about some aspects of the law, but we really chewed apart things with businesses, and we realized that there are some things that have changed in the tax law. If you make an election, you just check a box, you do it willy-nilly, you have basically chained yourself to that way of being taxed like forever. Right?
Yep.
Like getting married to the Bride of Frankenstein, and you want to make sure that you know what you're doing. Checking boxes can really mean long-term consequences, and so that's part of what we talked about. But one of the things,
and then I just wanted to say, you know, I hate to say this, but when you're using software like the box and you check a wrong box, you don't know because the computer software checks the box for you.
You
know?
That's
So
true.
just
But we're going to talk about some of those things that if you check the box, how it's chained to you forever for the rest of the show. But before we get into that, tax school started this week, right?
It sure did. It did. It started this week, which is so exciting. You could still register, but it's a great opportunity. That the hope is that you come work for us and you learn all about the tax reform. You learn all about the old law.
So you can pull your hair out too.
Yeah. You learn taxes from A to Z, and it's a great opportunity. There's also an online class that Tim has started today, and he tapes it so you could still catch up and
you can watch it and rewatch it and watch it and rewatch it, right? Mm-hmm. And even if you're in our school, you can watch Tim's class, right?
Absolutely,
So
definitely.
you kind of get it on both ends. If you didn't get it the first time around, you can watch it again, and you can watch it again and watch it again.
Yeah,
Right.
And then we have a Saturday class starting soon. What were we gonna
Starting in November 9th, I believe is the correct Saturday. We're starting a crashish course. 6 hours on a Saturday for about 6 Saturdays.
And let's face it, November starts to get cold. The time changes. You got your warm clothes on. What else are you going to do on a Saturday morning, right?
Yeah.
Right.
Yep.
Maybe we should have pumpkin pie at the class. So again, if you're interested in joining that Saturday class, because that'll be the next one, or if you only missed one class of our regular session that started last Thursday, you'd still have time. If you wanted to register Monday, we could get you caught up. But that Saturday class would be a great class to attend to if you still want to go.
And that's on our website now, so you could go there and register now or give us a call at the office on Monday.
All right, so we want to share with you some of the fun things. You know, I was sitting out in the lobby waiting for you guys at one of the seminars because I had already been to that seminar in the morning, and this lady there was also a seminar there with the autistic people. And she said, so what do you do? And I said, I'm a tax accountant. And she says, oh, this must be so boring for you. And I said, oh my gosh, it's not. It's wonderful. And she said, how do you figure? And I said, because it's a way to help people. I said, look, if you're a proctologist and you're learning about things of that end of the body, it may seem like it would be not fun, right? But if you're helping people, it's fun. And so that's really, and she said that was a good analogy.
And speaking
Taxes in your rear end.
and speaking of seminars, we are going to have one.
We are. So this is what one of the statistics we learned at Atlantic City. Do you know that 78% of small business owners right now in the United States are baby boomers? And which makes them senior citizens, and most of them do not have a business succession plan. And so we learned, it was great to hear these statistics because we said, wow, there's all these business owners that don't even know what to do with their businesses. Many of them just shut the doors, and really it's an asset and can be sold. And so we thought maybe we should, and by the way, a lot of the other things that we learned are for the QBI deduction, 20% pass through, some of those things that have come into contact. So we thought, why don't we do a seminar for small business owners to help them with a succession plan and final tax planning before the end of the year? So we were thinking of what would be a catchy name. So I came up with the name Banking on Your Business, right?
Yep.
And Chris came up with the name of?
My first one was 6 feet to succession.
So that meant that you have to die.
And we all laughed and laughed.
Okay.
But we all kept talking. And
then
talking.
the other one that you came up, which I kind of liked, was the secret to your succession.
Correct.
So what we would like people to let us know is which of these three should, because we're going to do this free seminar, which will help small business owners, people looking to get into business, people who have no succession plan, don't even know what a succession plan is, small business owners that don't understand what QBI is and how that's such a big deduction and how to make sure that they get the maximum bang for the buck and to make sure they don't check the wrong box and get married to a bad deduction for years and years and years and years and years. We're going to have this seminar, whether it's, do you like 6 feet to succession, banking on your business, or secret to my succession? We'd like to know, because we're going to put it on our website, and I kind of just think I like secret to my succession, banking on your business. So,
yeah, because
but
because it's not just about succession of your business; it's also how to make your business more tax advantageous and correct right now.
And my gosh, it's so important. Like, the top rate on C corps is 21%. The top rate on qualified personal service corporations are 21%. Who does that affect? Should you do it? All these kind of things we're going to talk about, and how to get that 20% pass through effectively, right?
Right.
I'm Esther Golias, the tax lady. Our phone number here in studio, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 3930, and we really want to help you. We're going to take a short break. We're going to be back on the other side with your calls, and we're going to talk about all this business stuff and personal stuff and all this stuff we learned this week and got excited about in Atlantic City. Talk to you on the other side.
We are family. I got all my sisters with me.
Hey, we think of you as family. I'm going to tell you, we're a tax firm locally owned and operated in Buffalo, New York. This is our 30th anniversary, by the way, this year. 30 years of serving people. We love people in Western New York, and we certainly want to serve you. So if you have any questions, 803-0930, 803-0930, star 930 on a cell phone. And why don't we go to our text first? A couple texts came in. 3930, right?
Right.
So the text is it possible to hear Tim's tape online? If not, registered for the EG tax course.
And that's not, it's for people that have registered.
Yep, so the
Right?
answer is no,
Because we got all the
unfortunately.
software we have to provide to them and everything.
Yeah.
And this way we can kind of control, we want to make sure that the people that are looking at it get all the correct information. So yeah, you actually have to register first. And so the next person want to know what's our website.
Yep, this is a
It's
different
egtax.com, right?
egtax.com, right?
Right. That's
right.
a hard one.
Yeah. And Tim does our website. He does a really good job, and lots chock full of good information.
Okay, and let's talk about some of the other things that we saw. We saw the new 1040 form, the projected new 1040 form. And one of the new things that is on there is what is the cryptocurrency you got last year?
Yeah, how much did you
Right?
receive?
What did you make in cryptocurrency?
get
So they're
any.
going to go after you if you think that you're going to avoid taxes by doing non-U.S. backed securities and income, dollars, etc. Because they are now starting to ask, did you receive income from cryptocurrency? That's on the tax return. That's one thing. The other thing is the 1040 form has been revamped again. They've eliminated one of the schedules. Which one? Schedule 4 is gone?
Schedule 5 and 6.
It's gone.
Because they revamped the 1040, so they made it a little bit bigger than. It's not just a half sheet of paper anymore.
Right. That's 3/4 of a sheet of paper.
Right.
That's so stupid. Anyway, so the 1040 is revamped. There's now a new 1040 SR for the seniors.
Yep. Larger
and
font.
Larger fonts, so you can see better. The other thing is there's a new form 14815, and that's for people that are getting child tax credit, earned income credits, any kind of refundable education credit, which basically will be sent to the taxpayer as a follow-up if you're claiming those credits, or could be sent to those taxpayers, which kind of is auditing the situation as to whether or not you had qualified children, making it available for you to claim that credit. So that's a brand new form, and I know we're going to do it as part of our interviews.
Yeah, that's
so
what I
we'll
was
have it
gonna
in our
say.
file ready to go.
Yep, they made a good suggestion. They said, you should have it printed out so you can hand it to people and you could review it with them, which is a really good idea.
Right. So it looks like the IRS is going after people because there is a lot of earned income credit abuse.
Oh, definitely. It's the biggest
And
area
child-
of fraud
right.
on a tax return.
Right.
Yeah.
So, this year, if you're somebody that's got an earned income credit, if your kid's got earned income credit, understand that the federal government is probably there's thinking at least 50% of the people are going to be getting this form. The
Just,
other thing that's new is the
I
1099
wanted
NEC.
to give an example. I was doing somebody's tax return the other day, and he was doing married filing separate. And his wife had already filed her return using software in the box. And they live together. They've lived together forever, and they have children. Well, she did head of household, and so she is a low income person, so she got the earned income credit. When I did his tax return, I did married separate, and it said, do they live in the same house? And I said, yes. I said, we have to amend her return because she shouldn't have gotten that earned income credit. But things like that happen all the time,
Yep, that's true.
So-
And that's what this new form 14815 is going to do. The other thing is there's a 1099 NEC, which I'm thrilled about, non-employee compensation. When you are not an employee, but you're performing a service, it used to be that they sent you a 1099 form with all these options. And many times people filled out the wrong box on that 1099. And so something that shouldn't have been taxed as non-employee compensation was taxed because they put it down incorrectly, and you'd have to go back to the person who typed it and said you did it wrong. So hopefully now with this 1099 NEC for non-employee compensation, it'll just be handled for people that are performing services for you.
Right, and that starts not for tax year 2019, but 2020.
Right. Okay? I'm Esther Gullius, the tax lady, back fresh from IRS convention at Atlantic City, which is interesting. Atlantic City's an interesting place, right? Mm-hmm. I didn't gamble. Did you gamble, Chris?
I think between me and my wife, we lost $30.
I didn't lose anything. 'cause
My
I'm
God,
not a
there
gambler.
were
Or $20,
so
$20.
many slot machines and
All
and
around.
tables.
Empty casino.
Right.
Well,
and
but-
a lot of velvet.
but
a lot
there
of
were
velvet and gold.
Yeah, I mean,
and
there were so many slot machines that there had to be a lot of empty ones. I mean, there were a lot of people at the slot machines too,
Yep.
in my opinion.
And there are many, many seniors. You want to stop them and say, "Oh my God, you don't know what you're doing," because when you you win money at the casino, you have to count the income. Even though you can take the expense as an itemized deduction, the income goes in and makes your Social Security more taxable. So it's just very bad tax planning, and that's something that EG Tax wants to help you with. If you're somebody that's won money at the casino, you want to make sure you talk to us so we can give you the heads up, because 85% of your Social Security may become taxable because of that.
Right.
Right.
And not to mention the other impacts on your tax, not on your tax return, but the higher income we'll have is with your
Against
enhanced
STAR,
STAR,
right?
your EPIC, your Medicare
I mean,
possibly.
it just is not a good idea to go and gamble at the casino, because there are all these bad things that can happen. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. Or let's talk about before we get into the QBID and all that stuff. Things that people should know. For instance, if you are a business owner, like maybe you have rental property or you have a small business and you have equipment and you're usually used to trading in maybe your truck that you use in business on a new truck and taking the adjusted basis and depreciating it. Or if you don't know, that's what your accountant's doing, that's what they're doing. Big change in the tax law. Now the trade-in has to be counted as a sale.
Right. That's right.
And it's recaptured as ordinary income because it's a 1245 asset. That's a big deal. So let's say before you got a new truck that costs $50,000, but you get $20,000 in a trade-in on the old truck, okay? But that's fully depreciated. So that means that when you do the tax return this year, you have a $20,000 sale that's going to be taxed as ordinary income, and the depreciation on the truck is going to be based upon the $50,000. So they're two separate transactions. You're going to have to account it as a sale when you trade it in, and you're going to have the fully depreciated asset that you have to depreciate using the new depreciation rules.
Right. And that's if you are depreciating. What about if, I wasn't, my person was using that standard mileage rate.
That's true.
You know,
That's true.
yeah.
So if it's fully depreciated under standard mileage rate, you're going to end up with the gain again of whatever it is, 20,000 for instance. But if you're taking the new business mileage, what is it, 58 cents this year, right?
Right.
If you're taking the business mileage, all you're going to get is 58 cents a mile. You might want to take a look at moving from standard mileage to the optional method where you take your actual expenses, because good things have happened for small business owners relative to the use of their car. There was all those limitations on the use of your business automobile. That's all changed in a good way, but the sale of your old car, not so much.
Right. Because now they let you do luxury car up to 50,000 to write off, which is really good. But if you are using your standard mileage rate and you trade in your car, that still counts as a sale on your tax return, because inside the standard mileage rate is built-in depreciation, which adjusts your basis. So you may have a gain there without even realizing it. And this is part of the tax law changes that happened last year.
That's right.
Because they limited the 1031 exchanges where it
Just
has
to
to
real
be.
estate.
Yep, just to real estate. So
Okay, so let's go back again. So we need you to let us know. We're going to have this business seminar to help you in business succession and get ready for the end of the year. We're going to talk about the QBID and the 20% pass-through and all what if you're a personal service corporation and you can't take the expenses, all those things of that nature. But we need to know. Chris says that we should call the business seminar 6 Feet to Success. I say let's do banking on your business. And then Chris also had another one called Secret to Your Succession. So what do you think?
You can
6 Feet to Success, Banking on Your Business, or Secret to Succession. And we're going to post that on our website when we hear from everybody, so they can register for that. And that'll be a great
and you can
seminar.
text in what you like today. When you call in, you can give us your answer. You can even do Ask the Tax Lady through our website and put in your response that way
6
too.
Feet to Success, Banking on Your Business, or Secret to Your Success. Succession. So that's what we're going to cover on that free seminar that we have. It should be great. Those of you that have attended our seminars, all the information that we give you is really, really, really important. And you don't have to be a client of ours. You don't have to come to EG Tax. We just want to impart the information, and hopefully you walk away with a new positive impression of EG Tax. And, at the Christmas party, she'll say, those people are awfully nice, right? I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And 3930 is our text number, right?
Yep.
The other thing that what many people are missing, especially small business owners, is that they don't have any kind of a qualified employee benefit package as part of their company because they've never adopted that. And how can that work for a small business? Now, they might say, let's say you're a realtor, and you say, well, I don't need a qualified employee business benefit for my company. Is that true? Do you guys agree with that?
No, I mean, if you could hire your husband, you could hire your child, and you could tuck so much stuff away inside of that plan that's unbelievable.
Right. So, and actually, EG Tax has a way to help you to get your qualified business plan for your business. And we're going to talk about that on the other side of the break. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. 3930 is our text. We're going to take a short break for the news, and we'll see you on the other side. Hey, we think of you as family. I'm Esther Gulius, the tax lady from EG Tax, in studio with Tiffany Fabian, Christopher Fabian. We're talking about if you're a small business owner, and that means like if you have a landscaping business, if you are a realtor, if you're an over-the-road trucker that owns your own truck. I mean, these are people that should have an employee benefit package, and you say, oh, that just sounds like so much trouble. Look at, if it would save you $2,000 a year, would it be worth it for the trouble? And I'll give you an example. If you get this, and we have the ability to hook you up with somebody that'll take care of the whole thing for you. This is part of what we learned at our seminar. You can let's say that you're a realtor and you're paying your own health insurance and you have a family plan, but you and your spouse is actually doing work for you. They might be doing the appointments, they might be doing the bookkeeping and all, and you haven't been paying them. Hire your spouse, set up this employee business plan, cancel your health insurance, pay for the health insurance for your spouse because you're giving them a salary, which would then be deductible. And then using the health insurance as an employee benefit, that's going to be deductible as to reduce your self-employment taxes. And you can also set up a medical reimbursement plan and reimburse them for their medical bills. And so you might end up with a $10,000 deduction on your Schedule C that you didn't have before. That would save you about $1,530 in FICA alone, plus the taxes. So it'd be well over a $2,000 savings just by doing a simple move like that. And those are things that we want to talk to you about. Our 6 Feet to Success seminar, Banking on Your Business seminar, or Secret to My Succession seminar that we're having, because we want to help you. And it really just is moving it from this line to that line using all the bells and whistles that are available to you. Right, guys?
Yep, definitely.
All right. We got some text, right?
Yep. Somebody texted, says, can I write off my payroll taxes that I pay and my insurance that I pay under the tax reform still?
Sure. I mean, businesses, if you're a business, whether you're a Schedule C self-employed, whether you're an 1120, 1120S partnership, that didn't change. What changed was what's not deductible is things that employees pay that are on a non-accountable plan. That's not deductible as an itemized deduction.
On the federal.
What you want to do is move it to an accountable plan, and that's something we will help when we do our business planning seminar as well.
Right.
And if you're an employee, you might just want to come because, we'll show you what your employer should be doing.
Right, absolutely. And there's so many people that should be moving to an accountable plan. And so many times, like drug companies, they advertise all these drugs on TV because the doctor doesn't do it. And so the hope from the drug company is if the consumer sees it, they tell their providers, right?
Right,
And so
right.
sometimes you got to tell your employer what to do, right?
Okay. Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and we got another one, right? Another text?
It says, can I get earned income credit if I file married, separate, and claiming my non-custodial child?
Not on the federal.
Right. Well, you're
Only on the state if you're paying through the New York State Collection Unit, and you would qualify for the earned income credit on the federal, but because they're being claimed by the custodial parent, you're not claiming them. So if you, on New York State, there is an earned income credit for people that would qualify who are paying through the New York State Collection.
Right.
Right.
agency.
And, you talked earlier today about that new Form 14815. I could see where a lot of divorced, I'm going to say dads, who are usually the non-custodial parents, may get these letters because you're supposed to be mailing in your 8332 saying you get to claim your non-custodial child. But how many of them really, if they're using TurboTax or they're using another software company, they just check the box and they don't mail anything in? The IRS, I can see now, especially if this custodial parent is claiming the child, saying, hey, send us the proof, and that's how they do it. They're going to do it now, is by that form. So you really, if you're going through a divorce or you just got divorced and you have children involved, call your attorney and say, am I supposed to have this? How come you didn't give this to me filled out when I got divorced so I can claim my children?
That's exactly, and I'll tell you, if you just got a divorce in 2019 and you're paying alimony,
That's what I was about
you're
to
going to be
say.
shocked to know you can't deduct it on the federal. You can deduct it on New York State, but not on the federal return. And it's not taxable on the federal to your non-spouse receiving the alimony, but it's taxable on the New York State return for them. So in essence, we are continuing doing two separate types of returns with two separate laws, one for the federal and one for New York State. The other thing I wanted to mention is how many of you have really looked, if you're younger, at how many quarters you have into Social Security. You need 40 quarters in order to collect Social Security when you finally get to retirement age. And those of you that don't have 40 quarters, especially if you're self-employed and maybe you've been operating at a business at a loss, you can make an election to pay FICA on your, even though you don't have a net profit, and that will give you 4 quarters that would go towards your 40 quarters. So that, again, that's something that we want to help people with if they are in need of getting 40 quarters and they're self-employed and they haven't been making money on their self-employment. There is a way around it by using the Schedule SE and making an election to voluntarily pay into the system.
Yep,
Right.
which is so smart. And you want to make sure you use, we talk about this all the time, all the tools in your toolbox. That's
But
what it's all about.
unfortunately, it's like looking at a giant toolbox, and there's so many tools in the toolbox, you don't know which is the tool for you. So you just shut the cupboard and say, I'm not gonna go there. I just don't know what to do. Right?
It's overwhelming.
It can be overwhelming. And I'll tell you, like when we were at that seminar, we said, oh my gosh, because now that a lot of the regs are rolled out, we find out that a lot of things, especially one of the things I was really shocked at was partnerships. Because really, any partner, every partnership should have a partnership agreement.
Right.
So, because the partnership agreement is what steers the way the partnership is handled. And with some of the regulations on partnerships and the rules, like for instance, everybody's sitting down at their computer, because everybody can now, they're doing these LLCs, right?
Right.
Well, if you have a 2-member LLC, you think, oh, well, I'm a happy Schedule C. Not really. You just turned into a partnership.
Yeah, and if you're a husband and wife, you are, if you make that election a partnership, or you have to do a partnership return too, a 1065.
So if you have an LLC with a 2-member LLC, that's a partnership. Now the partnership has you have to do the partnership return, and it's got to have an operating agreement. So you just made your life a lot more complicated. So you might want to remove one of the partners, one of the members. They're not partners. One of the members from the LLC, and go back to a single member LLC to get the coverage that you want. The other thing is, which was brought up at the seminar, is the veil of that LLC can be pierced if you're not doing things properly, if your bookkeeping is incorrect, if you're commingling funds, if you're saying, oh, well, I need to make my house payment, so I'm going to take the money out of my business, and you make a mortgage payment with your business checking account. All those things are incorrect. And those are things that we want to help you with to make sure that you don't end up with a big problem in an audit.
Right. In an audit, but could you imagine in a legal case? I'm sorry, you paid your mortgage. You don't have that. Now we can take your house.
That's true. Right, that's true. So if you're somebody that's done an LLC and you made it a 2-member LLC and you are on a Schedule C and you think that's how you're going to file again, not really. It should be on a 1065. And the penalty is what, $235 a month for not having the 1065 in?
Per partner.
Per partner.
Yep. And that's even, that's how about you and your brother have a rental property, and he claims half the income and half the expenses, and you claim half the income and half the expenses. Wrong. That's a partnership. You have to have a partnership return.
Oh my gosh. And the thing is, the penalties are astronomical. What really became clear to me the other day is that maybe you should just move to an 1120S and just avoid a lot of this problems that these partnerships have. So that's another thing that we want to
I thought you were going to say move out of the country.
No, this is a great country. It's a great country. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on the cell phone.
Esther,
you can text us at 3930, and we want to talk about that open enrollment.
That's what I was going to say. Don't forget, it's open enrollment if you are in Medicare, if you've just turned 65, or if you're over the age of 65, you can change your plan or you have to enroll. And Tim does a great job, and crew at EG Health Connect. So they're there right now. They're also doing seminars on Wednesdays and Saturdays. So if you need information, you can meet one-on-one, and we have a great training center, and you just learn there's so many different options. Tim calls them different lines. So there's all these different lines, and one, Independent Health might be right for you, or Fidelis, there's different options. And so depending on your circumstances, he does a healthcare inventory, and he looks at what's best for your needs, And those
All right,
seminars.
and let's talk about here just before we go to the break. If you're a business owner, one of the good things is this year there's 100% bonus depreciation. So if you buy, and they'll let you expense a roof, right?
Right?
Which you never.
I mean, a roof.
You had to
it used to
always-
be you'd have to take 39 years to write off a roof. Now you can write it off. So, which is really good on the left-hand side. But if there's no net profit on your business, what happens to your QBI?
Then there is no
You
QBI.
don't get any.
Yep.
So this needs planning. So the QBI is that 20% pass-through that you'd get on the net profit. So even though there's 100% bonus depreciation and you can write off even a roof that you'd have to depreciate before, you want to make sure that you're planning properly. And the maximum depreciation this year and bonus depreciation on a new vehicle has all the way gone up to $18,100. That's unbelievable.
That's
Right?
incredible.
Because they used to say if it's a luxury vehicle, it was like $3,900 back in
Yep.
the day, not too long ago. So, and then the QBID is very complicated, and we're going to talk about that on the other side of the break. But the bottom line, it saves you money, so you want to understand it as best as you can. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone, 3930 is our text. We'll see you on the other side.
We are family. I got all my sisters with
Hey, you're family to us. I'm Esther Goulias, the tax lady from EG Tax. I'm joined in studio with Tiffany Fabian, Christopher Fabian. We're talking about some of the things that were at the top of our list when we went to this IRS convention this week in Atlantic City. And specifically because it's so confusing, a lot of it is confusing, let me tell you. But what's really confusing is this new qualified business income deduction, which is lovingly called the 20% pass-through. The important thing is that you understand that once you have made, you've said that that was a qualified business income deduction, it has to fall in the future years unless you terminate it, sell it, or liquidate it. So once it's on there, it's on there. And especially people that have rental property who would like to be able to take the QBID deduction, in order for rental property to qualify, it has to be handled like a business.
Right.
So let's talk about what that
hours.
means to somebody. Chris, Tiff.
Well, you have to have its own checking account. First of all,
Can't commingle funds.
Can't commingle funds. It has to. You have to have at least 250 hours in per year into
Of managing it.
managing
Your
it.
active participation.
Right. And you have to run it like a business. You have to have a profit motive. If your daughter lives there and you're charging her $300 instead of $700, that's not a profit motive, so they won't allow you to take the QBI. Sorry.
All right, and the other thing is you have to make sure that you're issuing 1099s. Let's say you got Pete's snow removal place that does your snow removal on your 10 rentals, and you don't send him a 1099 and you paid him more than $600 and he's not a corporation. That's wrong. That would say to the IRS, you don't qualify for QBID. It's not a qualified business. You're not treating it like a business. So these are things that the business owner, if you want the deduction, and it's 20% of the bottom line, it's a big deduction. If you want the deduction, you have to modify and make sure that you're dotting your I's and crossing your T's, and that's part of what EG Tax will help you with. And again, if you're interested in this, we have our seminar, the 6 Feet to Success seminar, the Banking on Your Business seminar, or Secret to Your Succession seminar, depending upon what you guys say, where we're going to cover all this and help you one-on-one.
And
Yeah,
then
Tiff.
don't forget, if you're doing the QBI on your 2019 return, if you had a loss on your QBI the year before, you have to enter that on the QBI form.
That's exactly right. So let's say in 2018 you had a small business that started off with a $10,000 loss and it was qualified business income. That $10,000 carries forward to this year. So maybe you have a $40,000 net profit on your business. So you think you're going to get an $8,000 deduction, but you're going to have to net the 40 with the last year's loss of 10. That brings it down to 30 and you'll get a $6,000 deduction.
Yeah, and so the IRS
just
has
some of
got a-
those things are in there.
The IRS has a big job ahead of them, you know?
They certainly do.
Yeah.
And the truth is, I think our taxpayers have a big job in front of them because, most of my the professionals that I deal with that are self-employed, they are great at making money as a self-employed person. They really need the write-off, right?
That's right.
But they don't really like doing the bookkeeping. But really, you kind of shoot yourself in the foot if you can't do the bookkeeping. So we want to talk about how to accomplish that so it's a win-win situation. And first of all, knowing what you need to do is the most important part so that you start doing it so that you don't lose this deduction.
Yep, we got Marcia on line one.
Hey, Marcia, I'm Esther Goulias. How can we help you?
Yeah, hi. I was just catching the show. I have a bunch of rental properties up in Buffalo that I have. Some that are rentals. Well, they're all rentals, but some are profitable, some aren't. Do I get that credit you guys were talking about?
All right, so number one, it has to be handled like a business. So how many rentals do you have, Martha?
7.
You have 7 rentals. So are you at least spending 250 hours a year managing them?
Yeah, I'm like there every day, a couple hours a day, cleaning up here, cleaning up there.
All right, and how about bank account? Do you have a separate bank account for your rental properties? Or are you commingling funds?
They're for their own bank account, but I have my own. But I use one bank account for all 7, and then I have my own personal bank account.
Okay. So the important thing is you want to make sure that you're handling it as a business, right? You want to make sure. And are you issuing 1099s at the end of the year for your people doing subcontractor work?
No.
That's something you want to make sure you do. Why don't you explain that, Martha, about what that would be, you guys?
Right. If you pay an individual more than $600 a year, you have to mail them a 1099 miscellaneous and
Soon to
state.
change. Oh no, that'll stay the same.
No, that will be an NEC next year.
NEC next
Yep.
year.
And so to signify that it was an individual and not a corporation, and you pay them, and you need that to mail that to them to write off that expense. Even though you have a receipt, well, most of the time people don't when they pay cash, but you got to mail them that 1099 in order to claim that expense. And if you don't do that now, especially with this QBI, they're going to say you're not doing it right, and they could back away that 20%.
You know, we've all gotten those W-9s where people ask for our social security number. So those people doing work for you, you'd want to give them a W-9 so you can ask for the information to issue them that 1099 at the end of the year.
But Martha, you'd be a perfect person to come to our seminar because you want to make sure that let's face it, 20%, if your bottom line was $20,000 on your rentals, it's $4,000 deduction. You'd want to make sure you're able to take that deduction. So the seminar's absolutely no charge. You can go to our website. We will sit with you one-on-one and help you with your questions.
Which name do you like better? Banking on your business, secrets to your succession, or
6 feet to success. Or 6 feet to success.
A, B, or C? Marcia?
Banking on my business sounds good.
That sounds normal, right? Although I like secret to your succession as well. So give us a call, Marcia, but you don't have to wait till the seminar. You can call us anytime at 632-7886 as well, okay?
Well, thank you.
Thanks a lot. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. All right, the other thing is...
Wait. You know, one thing with Marcia is she's got to be careful, especially with rental properties, because she said some make money, some lose money. If she makes that election and she's putting them all under that QBI, they are stuck in that election forever. Right. So if one of them that was making money starts losing money, that's going to impact the QBI going forward. So she's got to be really careful.
Right. And so the thing is, if Marcia has property, let's say she's got a small business as well, and her small business is making $30,000, but her rentals, because she put them in maybe several years ago, are with a $20,000 loss, she's going to actually shoot herself in the foot by the 20,000 times 20% or 4,000 because they're in there. And once they're in there, they have to be in there. So that's why it's so important that you business owners or rental people understand that this QBI decision is not just a simple checking of a box.
That sounds really confusing.
And which is another thing. If you're getting K1s, because maybe you're a partner in a partnership or a partner in a 1120S, you got to make sure that the proper codes are on the K1 in order to qualify for the QBI, because if there's no code on there showing what type of business it is, then you don't get the QBI at all. You got to send it back to the accountant that did it and say, put the codes in here or else I don't get the deduction.
Mm-hmm. That happened with some of my clients. Yep.
All right. The other thing is, and for those people that have income in excess of $315,000, and they would be subject to the 20% pass-through isn't allowable to them unless they have wages as well. And so if you're a single owner with income of over $315,000 and you haven't been paying yourself a large salary, let's say you've been paying yourself $50,000, well, your QBI deduction is going to be limited to 0.025% of your assets or 25% of your wages. And if your only wages are you, then all you're going to do is get a $12,500 QBI deduction. It would be better for you to take an extra salary, which would then get you a QBI deduction of $25,000, because that's something you want to make that decision before December 31st. That's really important to you. Half the tax plan And there's a lot of moving parts, and so that's part of why we're so excited about offering one of the 3 seminars, either 6 Feet to Success, Banking on Your Business, or Secret to My Succession. And of course, that'll be a free seminar that we have in November, right?
Correct.
Yep, we'll have guests and speakers and presentations, lots of fun.
The other thing we found out was there was a Schedule D error last year, and the IRS is going to correct it and start sending off refunds.
Themselves.
You're not supposed to do anything. Well, they don't know when they're going to be sending the refunds, but you're not supposed to do the
Amended return.
The amended return. They're supposed to self-correct.
And also that goes with the penalty if you didn't pay if you owed over $1,000, the penalty from 90% of last year went to 85%, then it went to 80%. They're supposedly self-correcting those as well.
And what was the error on the Schedule D?
Taxing people at 28% instead of 25%.
Right, which is 3%.
Right.
Yeah.
Right.
So
So if you're a small business owner, you have rental property, you're wondering how to do this. If you're an LLC with 2 members and you found out that you are now a partnership and you want to shoot yourself in the head because you did that, you think, oh my gosh, what am I going to do?
Yeah.
EG Tax is there to help you. You can call us. Extension deadline is over, so we have some time. We're doing training this time of year.
And then don't
we have
forget-
some time. We'd love to help you.
And
Yeah,
then
Deb.
don't forget, if you get a letter, to give it to us. Don't just pay it. A lot of letters are people who have the penalty for failure to pay the correct amount. And so, as Chris said, with the change in the tax law, where it went all the way to 80% of your tax from the year prior, you might not owe that. The letters that I've been seeing lately are, you didn't pay the correct amount of tax, and so you owe us more tax. But make
All right,
sure
the
you
other,
show
and the
it
other
to
thing
us.
is, if you're a C corporation, the maximum tax rate is flat rate is 21%. If your net profit is very low or you have no net profit, you should seriously, I'm pleading with you, move to an 1120S, because that loss would be a carry forward to your personal return. Could be taxed as low as 10% or 0% on the federal because it's a pass-through. You are really shooting yourself in the foot, and many times corporations are in that because of a fiscal year. EG Tax will help you with that too. Or go back to your accountant and say, why am I doing this? Right? And call us
Ask
first. We'll
questions.
give you the words to say. Until next week, I'm Esther Gulius, the tax lady from EG Tax. Remember, we have our Saturday class that's going to start, or you can go to our online class. You can go to our website at egtax.com. Tiff, you got anything to say?
Just
Have a good
week.
squish
Have a
the
blessed-
fish.
Wow.
Squish the fish.
That's right.
I'm Esther Gulius, the tax lady. Have a great week. Thanks for listening. God bless. Bye-bye.